Anyway, guys, just focus on the areas which we are going to discuss. Let me explain you faster. I'm taking much time on this area. So now let's start, guys, again from the beginning. Yeah. The diagram below shows demand and supply curves for a goods sold in competitive market. Assume that the government has now imposed an excise tax of 60 per unit on producers on this market. You know what is an excise tax? Excise tax is like to limit the consumption of the good. They might put a tax because that's a demerit good for the entire society. A demerit good is like consumption, overconsumption of the product actually will bring not goodness to the society. So now here I'm going to put a tax because they are saying in 60 rupees actually the tax was imposed. So I'm going to draw a line here from 60 onwards above. So if this 60 is above going, it is intersecting 90s point, that is your new equilibrium price. Now with that idea, we are going to write the how much will consumer surplus change as a result of the tax. Let me do it here, guys. I'm going to whiteboard. Before consumer surplus was, before tax consumer surplus was how much, guys? We found it was actually the maximum price they are given already on the sum. So maximum price is 120. You don't want to find because the touching point of the demand curve is the maximum price. So 120 and your earlier equivalent price was 60. So I'll write here 120 into 60 to find the actual value. 120 minus 60. That is the formula because maximum price minus equilibrium price into equilibrium quantity. So equivalent quantity is 2000. You can see when it comes to equilibrium at 60. When it comes to 60, it is 2000. So I'll take 2000. And the formula is that maximum price minus equilibrium price into equilibrium quantity by divided by 2. So if I write the formula, I'll get 120 minus 60 is 60. 60 into 2000 is 120,000. 120,000 divided by 2 is 60,000. This is before tax consumer surplus. Then I move on to the next formula, which is the after tax consumer surplus, in order to find out how it works. So after tax consumer surplus. Okay. So I'm going to write here after tax consumer surplus as, how do you write the formula for this? Again, maximum price, but new equilibrium price. So new equilibrium price divide by new equilibrium quantity and divide by 2. So if I have maximum price is how much? Here the maximum price is going to be the same. It will not change 120. Minus new equilibrium price is going to be 90. You guys can see this as 90. So 90 divide by, into equilibrium quantity is how much, guys? The new equilibrium quantity is going to be 1000 because this intersecting line, you can see my cursor. This is actually 1000. So I'll take it as 1000 here and in divide by 2. So 120 minus 90 is 30. 30 into 1000 is 30,000 divided by 2 is 15,000. So 15,000. So now earlier you got before tax consumer surplus was, how much, guys? It was 60,000. Now it is how much? You are getting a value of after tax consumer surplus 15,000. If I deduct, what is my actual change? My actual change is 45,000. So please copy it down, guys. By how much will producer surplus change as a result of the tax? How to write the producer surplus? The same before tax. Before tax producer surplus. I'm gonna find producer surplus. How do you find this, guys? Easy. I'm going to take the before tax. What is the normal formula you take? Equilibrium price. So EP minus minimum price MP into equilibrium quantity EQ divided by 2. So now equilibrium price earlier it was 60 rupees, which you all know because it is intersecting at this point. So 60 and minimum price is the place where your 0 is meeting. So I will take supply. This is the place where your minimum price is 0 because there's no more down. You can take the supply curve. They are taken it to 0. So equilibrium quantity is going to be 2000 divided by 2. So 60 into 2000 is 120,000 divided by 2 is going to be 60,000. That is before tax producer surplus. So after tax producer surplus is how much? So after tax producer surplus. How do you find this, guys? So I can find this easily. I will take again the amount new equilibrium price. I'm not going to take the old equilibrium price. Now I'm going to take new equilibrium price. How do I take this new equilibrium price? I have to be very careful when I'm taking. The line is intersecting from this area, guys, as I do already. I'll draw it and show you. The line is going from 60 to from this area. it is touching the 90, but when I'm taking the consumer's amount, I took 90 as the price. But when I take the producers, I will come along the line, this line, and I will see it is intersecting what line, guys? It is intersecting 30. So actually for produce, I will take the downward part, which is the 90 as the new equilibrium price. And minus what is the amount we should take, the same formula we need to apply. I will take new equilibrium price minus minimum price, then into equilibrium quantity divided by 2. Now, when I take the new equilibrium price, it's going to be 30 rupees and minimum price is going to be 0 because it's starting from the 0. It will not change. Equilibrium quantity is going to start with 1000 and I will take 1000 divide by 2. So when I take 30 minus 0 is 30 into 1000 is 30,000. Divide by 2 is going to be 15,000. So actually here also you are losing some sort of value. So you are getting here amount of 15,000. Now in this 15,000, yeah, in this 15,000, now you need to know the differences between the before tax produce surplus and after tax produce surplus. I will take before tax produce surplus and I will deduct the after tax producer surplus. So before tax produce surplus was 60,000. After tax produce surplus was 15,000. So you're losing actually 45,000 producer surplus lost producer surplus. So you can see, you can explain this because of the tax, it has been lost. So the change in result of tax is 45,000. If you write 45,000 also, it's correct. How much revenue will the government collect from the excise tax? As you already know, which we do a curve from here, I'm going to show you how much the government is going to collect. 60, it is intersecting 90, that is the tax curve. So I'll say S plus T, which is the tax. Now at 90 to 30, this is the actual difference the government is actually earning. So how much is the government earning? From 90 to 30, that is the market the government is actually earning. So how much is the government's main income? So we can take the difference P2 to P1, the difference, actual difference is 90 to 30. We can know the difference of the prices. How much is the price difference? 60. And I can see the number of quantity, which is the government revenue is taken the difference in price into quantity. This is how you find the formula, difference in price into quantity. So now, because of the government tax, the quantity changes from 2000 to 1000. So I'll take 60 into 1000. So government is earning an income of 60,000. It's an easy one, guys. Then we move on to the next part. Calculate the deadweight loss created by the tax. So what is the actual deadweight loss created by the tax? Now, what is this deadweight loss? This is the amount of value the government has actually when you are having this government. What is the amount you are going to lose? Now, the amount you are going to lose is going to be easy. This difference into this quantity. Now, you are losing from 2000 to 1000. That is the quantity you are losing, which is 1000. And you are losing 90 to 30, which is 60 rupees. So, I will take deadweight loss in this way. So how did I find? I found the difference in price. I found the difference in quantity in both. So when I find the difference in price was how much, guys? 60, 90 to 30. Then difference in quantity was how much, guys? Difference in quantity was from 2000 to 1000. It is 1000. So this is divided into two breakage because producer surplus also should bear something and consumer surplus should also bear something. So I'll take 60,000 into divide by 2. So you'll get a value of deadweight loss 30,000. Let me explain you why the deadweight loss was 30,000. Now you might see here the difference between this 1000 and 2000 was 1000. That's the actual quantity I took here as 1000. And the difference between this 30 and 90, I got a value of how much? 60. So this 16 to 1000 was the actual deadweight loss. Lost, it should be LOST, guys, not LOST. It's wrong here. So now 60 into 1000 is the actual value, which we got 60,000. But this deadweight loss is divided into both people in both parties. You might see as this is the deadweight loss area, guys. I will divide this deadweight loss among the consumer, this part, and among the producer, this part. That's the reason I'm dividing it by 2 because there are two breakage from this point of view. I hope you guys understood this particular question of how to analyze and understand a tax